Well, one man that's keeping a close eye on the economy, what we should do, the stimulus we need, is Stephen Koukoulas from Market Economics. Thanks for your time.
Good afternoon.
Thumbs up to the infrastructure, the sort of, well, measured is what Scott Morrison's keen to emphasise here. We're not in the GFC, so we've got the tax cuts, the rate cuts, a bit of infrastructure.
I can relate to that actually because the economy's not performing well. I think that's the starting point, and that's why we have interest rates where they are. Now, that said, we've got some, the gentle turn, I think, as the Reserve Bank Governor likes to put the phrase, and I think that's right. If we look at 2020, at things like capital expenditure, export sector, we look at the infrastructure rollout, even prior to the recent announcement, that there's going to be a little bit of economic growth coming from those sources. The hard one at the moment is the household consumer side of the economy, but the extra infrastructure spending, look, it's not going to cause people to go out and change their GDP forecasts by very much, but it's a sign that the government's at least stepping up a bit, doing its little bit to contribute to make sure 2020 is a better year for the economy.
So is the government right in its policy still? Let's not panic. We're coming through to Christmas. We're going to have MyEFO. We're not going to do anything major in MyEFO. We're going to have a budget. Let's just see the tax cuts are still washing through, etc.
I'd do more. I think.
What would you do?
I would actually sort of bring forward the tax cuts. I think we need a bit of here and now stimulus.
Well,
not massively.
They wouldn't be here and now though, right? Because they're mid-2022. So when would you bring them forward a year? Is that tangible enough?
I'd bring them forward to 1 January. I know it costs the budget a lot of money, but you bring them forward because it's the here and now that we need this stimulus.
So bring them forward 2.5 years?
Yeah, I'd do something because the economy is only growing at 1.4%. The labour market numbers that we saw last week, we had the double of rising unemployment, falling employment. It wasn't a good result, and to cap it off, we had wages growth actually going backwards. So again, nowhere near a GFC type scenario, but it's one of the things, if you want to guarantee it, you pump an extra couple of $1 billion into the economy now, in concert with the tax cuts that have already been delivered, in concert with the RBA monetary policy stimulus, just to make sure that we get 3% GDP
What would that be? I'm trying to think what that figure would be, because obviously you're not talking about a baked-in change. They're going to come in anyway, but 2.5 years extra of those is all coming off money we were supposed to be paying off debt, basically.
And those surpluses in 2021 and 21-22 were substantial. They were sort of 15, 18, 20 billion.
So we're talking about quite a few billion, 10 billion?
You're talking about 5 billion per annum.
Right.
So, OK, we've only got
12.5 billion.
7 billion surplus this year, so that would probably be trimmed down to about 3 or 4.
It's significant when the government says, you know, we want to deliver on this, because that could, a few other things go wrong for them and they're going to be in a technical balance again.
True, but we've got to also remember that the iron ore price continues to shoot out the lights. It's at $85 a tonne. They're getting a benefit from that, and probably they're going to have a bit of a downgrade based on that weak wages growth that we were just talking about. That'll cost them a little bit of money as well. But we'll find out all in MyEFO, of course. But it looks as if the surplus is pretty much locked in, giving a little bit of extra stimulus to the economy when it needs it, not in 2022-23. We might be booming.
If you bring it forward a year, it at least makes it more tangible. You know, if it's mid-2021, people can almost go, all right, that's going to happen now, and I've already got a tax cut that's coming in at the moment, and the rate cuts have happened, so I'm feeling better. That could relax things a bit.
It could a bit, but again, it's this question, 2021 is a long way away, and if we get the housing price boom unfolding by then, and the conditions for strong house prices have been put in place already. We know that Sydney and Melbourne, they're up 7% in 5 months.
Now, I know you love updating on this, daily, monthly sometimes, and you've been talking a lot about household debt. We're pretty obsessed with that figure in Australia, but you always point out it's all relative to what your household's worth, and as value's going up, I mean, no one obsesses about debt, they obsess about their assets compared to debt.
Correct, and it's sort of like a question, if I can answer it this way. If I've got debt, say, of $1,000, is that a lot or a little? The answer is you don't know what's on the other side of the balance sheet.
What do you earn and what have you got?
If I've got assets of $10,000, the debt's not a problem. If I've only got assets of $1, that is a problem. So we've got debt, sure, it's a record high, 190% of household income, one of the highest in the world. But if we look at the asset side, the money that we've got in housing, the money we've got in superannuation, the money we've got in deposits at the bank, that is 1,000% of income. So net financial wealth is around about 800% of income. Sure, debt's 200, but we've got 1,000%.
So record household debt, you could basically say that every year.
Yeah, and we've got record household wealth.
Yeah. when we talk about as well the rate cuts and their impact, the day of when people are going to feel better must be getting closer too, right? Because they've been using that to pay off debt. It's stockpiled, basically.
It is stockpiling savings, that's right. So to the extent that we've perhaps been a little disappointed that people didn't go out earlier and spend the tax cuts, the interest rate cuts that have already been delivered, the retail sales numbers are still quite soggy. The money's in the bank. The people have still got that either lower debt, they've paid off credit cards more, because we know the credit card balances are shrinking quite rapidly, or they've put the money on deposit, even if they're not getting a very high interest rate. So the money's there. It's like the coiled spring. I don't know what causes people to then go out and spend that money, but their financial health has improved with tax cuts, interest rate cuts, and the fact that the economy's still growing.
Maybe we should rejoice. Maybe we're becoming better economic managers. We're cautious. Nothing wrong with a well-run household. Maybe the, what's her name, Mary Kondo effect is we're all minimalists. I mean, is there anything wrong with ignoring the Treasurer when he says take out your credit card and buy some plastic?
Look, I think these social changes are huge too. That you know, the what do we call it, recycled clothing and all these other things which my kids love to buy.
I bet you appreciate that
good.
too.
Oh, it's as cheap as chips. It's great. I love it.
We're
but
going
it's
to
probably
sell those again, kids.
Not great for the retailers. However, that trend's going to sort of feed into the economy. It's going through this transitional change.
Yeah.
And the really strong competition from other retailers, the big Amazons and Aldis and these sorts of people coming in, are sort of forcing a change in the way we spend our money as well.
And that can feed into cars. I mean, as people turn 18 now, they don't get a car straight away.
Correct.
They used to.
Correct. And in fact, one of the issues with this slump in car sales is a reflection of the fact that people are living in the city. We are improving our urban public sector transport, slowly but surely. If you lived in the middle of Sydney, why would you own a car?